Hello and welcome to the show. I'm Kim Parley. Thank you so much for joining us. Well, if you're like me, you've been watching the TV, you've been reading the headlines, and Donald Trump is plastered everywhere. And it seems every 5 minutes we're hearing about something new and the impact that could have on the markets and the economy. I myself was feeling a little bit exhausted, so I wanted to sit down with someone who could basically cut through it all and tell us what she is focused on. So I had a chance to sit down with Beata Caranci. She's chief economist at TD Bank, and I asked her just to please level set. Tell us what is important to watch right now.
Some things have changed and some things haven't. So what hasn't is that the U.S. economy had strong momentum going into the new presidency and continues to maintain it. So he has inherited a very solid fundamental economy. That remains the same. Obviously, with the inauguration following the days that followed, we had a lot of executive orders announced. Nobody quite knew what those executive orders were, the priorities were going to be. We're starting to see where they are. There's been, in terms of immigration ban on 7 countries from a temporary perspective. These are not typically pro-growth policies. So what I think many had expected is that you would come into the new presidency with a focus on corporate and personal income tax reform, which was really a key pillar of the election campaign. And in fact, that looks like now it's going to be negotiated over the summer, perhaps some implementation by the end of the year, real impacts not occurring to the economy till 2018. And instead, what we're hearing right out of the gate are things that inhibit immigration, things that inhibit trade, and so all of those tend not to be pro-growth policies. So what we're getting is more of the stickiness on the policy side as opposed to the ones that, lubricate the economy.
Let me, the stickiness you talk about, I mean, do we have a sense of, and again, early days, but is this going to, is it friction? Is it going to slow things down? Because, the markets, the equity markets, have priced in all the upside from tax and fiscal spending. But I don't know if do we understand the impact of this friction from trade, immigration, all that kind of stuff?
Still too early to know for certain on that, right? So I think markets are very much in a wait and see mode. We had a Federal Reserve central bank meeting a week ago as well, and they even took a very wait and see approach as well in terms of not commenting on anything, and that's what we would expect. We never actually built in any fiscal stimulus into our forecast for exactly this reason. So we approached it from a conservative perspective with the understanding that fiscal policy changes do, especially when you're talking about tax reform, that's huge. We've seen many attempts at this in the past, even bipartisan agreements fall through. So we want to make sure that we see the policies before we start building them into the forecast. So I think from the market's perspective, the euphoria has gone as far as it can based on the speculation of what's to come. And now we need to see the government start to deliver on some of those things, like the tax reform in particular, to give business investment a boost, household consumption a boost as well. So I actually don't think we're going to see those measures until the end of this year, potentially 2018. But the market, as long as it's still on the table, I think will remain relatively stable, as long as there's nothing that's saying we're changing direction from those expectations.
Now, there's lots of other things too in terms of deregulation, all that kind of good stuff that they've talked about as well. What I thought was interesting in a note you put out recently is you talked about the fact that business investment is ripe to accelerate, and showing the numbers in terms of manufacturing, small business confidence, all that kind of stuff. Is the friction going to impact that?
Yeah, so this is where, left to its own devices, the U.S. economy is already on a path where you're seeing a recovery in business investment, which was actually quite disappointing in the last couple of years, in part because of the energy sector that really, put a hollowed out a big investment initiative for the last 2 years, and that's part of the recovery. But we've always seen in the U.S. that corporate profits have been very high as a share of the economy, and we just haven't seen that flow through to investment. It's not a U.S. story. It's an actual international story. But it's possible with the positive sentiment that's happening in the U.S. among small businesses and others, with things like deregulation on the table, that you can get a bit of an animal spirits here, where you have companies who have been sitting on cash and being conservative with uncertainty on the outlook, now feeling a bit more confident in the fundamentals of the U.S. economy. And if we get corporate tax initiatives that help in that way, you get a little bit of an accelerator to that sentiment. So it's certainly possible that we're going to see, we absolutely expect growth in business investment. We're already starting to see the tailwind of that coming through. But we think it's possible, if you do get policy initiatives that are promoting it in 2018, it will act as an accelerator to momentum that's already there.
Let me ask you to get very tactical for a second. I mean, you talked about tax, and you don't see that happening until 2018. You wrote a note recently about destination-based cash flow, talking about some of the different taxation possibilities. What is that, and what does that mean, so that people can understand what the impact could be?
So this is what it's commonly referred to. The acronym is BAT, or BATS, Border Adjustment Taxes.
Yeah.
And so this is a concept that for the U.S., their tax base right now will tax profits. So your revenues minus your expenditures, and you tax your profits at 35%, whatever it's going to be. And so the notion is that now what they're going to do is perhaps put out a policy where they lower that tax rate to 25%, whatever they choose that metric to be. And they are not going to tax anything that you ship out as an export. So any revenue that's related to export revenue, it's going to be tax-free, so not as part of your profit tax base. But on the flip side, where you would have received a tax credit on your expenses, if those expenses are related to imports, you no longer get to claim that. So your taxes will rise if you're a higher import company, where your products are used for domestic consumption, and if you're an export-oriented company, your tax base will drop. And so you're shifting almost your wealth from those companies that are importers over to those that are exporters. And so this is where you're getting a lot of chatter happening in terms of this could be quite negative for Canada, because you're going to have much more competitive exports come into the market as a result of it, and import prices rise in the U.S.
I want to get to Canada because that's a big deal. I just want to put that aside for a second. But are there any unforeseen consequences of that even happening in the States? I mean, because I know with all these things, as you know, this is what you do, is policies are put in place, but they say, well, what about this? And you see all the ripple effects go elsewhere. So is it going to do what it intends to do in the States?
There's two kind of offsetting impacts that start to happen that is anticipated. One is when your relative prices of exports to imports fall. What will likely happen is the U.S. dollar is going to rise. And so part of the higher taxes that importers are paying for will actually have a little bit of a benefit from the fact that the dollar rises and they're importing at a slightly lower cost. So this is what the government is counting on as some kind of an offset to the taxes being really hit hard on the importers of the U.S. Having said that, it's more likely you're going to see a pass through to higher consumer prices, because ultimately things like industries that have very high import content are, your clothing industries, your electronics industries, autos obviously crossing the border many times over, potentially 5 times in the case of Canada and the U.S. So ultimately you could pass on higher consumer prices. So on the one hand, you're lowering or anticipated to lower personal income taxes, and then on the other hand, you're forcing people to pay more. And those areas where those taxes are likely to get hit the most are going to be things like clothing, which disproportionately hit lower income individuals. So those are those unintended consequences where they're trying to level out the playing field on their trade deficit, but at the end, someone's got to pay for it, and it'll also be the American consumers themselves paying for it.
Welcome back. We've been just talking to Beata Caranci. She's the chief economist at TD Bank, and talking to her about, again, cutting through all the noise of everything that's going on with President Trump and trying to understand what really matters and what she's focused on. She outlined what was going to happen with the states, in her opinion, things to watch, and now we want to turn that conversation to Canada, and there's some unexpected things she thinks that could happen. Take a listen.
Canada is actually not the target of, or the main area of interest for the U.S. in terms of the trade composition. It's really Mexico, and frankly, the deficit is largest by a wide measure with China. So it's not only deteriorating in terms of the trade deficit in the U.S., but it's continuing to widen against China. At least with Mexico as a share of the U.S. economy, it's stable. And with Canada, there's a lot of misconceptions there. Canada runs a deficit with the U.S. when it comes to services. So we import more than we export, and we also run a deficit in goods when you strip off oil and gas. So we have, if anything, very fair trade with the U.S., and I think the Canadians actually have a case to be made that, we're running deficits in these two big components. And really, it's the oil and gas sector that's allowing us to run a goods trade surplus, just that one sector.
What about, though, business investment animal spirits? I mean, you talked about that in the States, and it could reignite things, but at the cost of, I'm just thinking human nature. If I have factories, and I'm not saying this is common, but if you could have a choice to build here in the States, you might choose south.
Yeah, so businesses don't like uncertainty.
Yeah.
And certainly from the Canadian perspective, while the U.S. is benefiting, I think, from the feeling that it's not going to be worse for them, and on net the risks are to the upside in terms of what they might see in tax initiatives and the boost to investment. I think Canada's literally the opposite. That our key market for exports is looking a lot more uncertain in terms of market access and in terms of our cost structures that are going to be affected. So it could certainly delay investment decisions until businesses get a sense of what does that platform look like? What does that environment look like? And we already in Canada have seen delayed investment intentions. We already have a low level of investment happening. Like I said earlier on, this is a global phenomena happening, so this certainly doesn't help in that respect. The one exception that we're starting to see come through the data is, again, this oil and gas sector. We've seen a lot of activity pickup in the US, in Canada, with the stabilization of oil prices and with projects coming online in Canada. So that's offering a pretty much of a bright light at this stage, that we're bouncing off very low levels, and that can give a nice boost to GDP in the coming year. But outside of that, if you're a manufacturer, if you're in the auto sector, and you're hitting capacity pressures, odds are you're not going to be too aggressive on the expansion side until you know what that market looks like.
I've got about a minute left, so I'm going to try and squeeze two things in. Currency, what does this all mean for Canada? And also benefits. How do we benefit from what's going on in the States right now? Because I've heard anecdotally, and I don't know if this is material, but immigration. We could see a flow of immigration into Canada. Mm-hmm.
That's possible in terms of the high skilled, because so far what we've heard out of the new administration is not pro-immigration. And they're even wanting to take a look at the H-1B visa, which is their skilled immigration. So a lot of opportunities from that perspective. There's also the opportunity that if this new administration doesn't make Canada the center of their focus and does make China and Mexico more the focus, Canada has been losing market share to the U.S. to these countries. So there's an opportunity there. If we're not that center of tax base that happens, we could pick up market share, or at least not continue to lose market share. So there's some positive that could flow through. It's too early to know.
Yeah, and at the end of the day, what the heck does this mean for the loonie? Because it's been interesting.
There is the potential that we can see some downward pressure. I would say if you look at the balance of risks around the loonie, they would be overweighted to the downside right now relative to the upside. If the U.S. does put in a border adjustment tax, in order for that to be neutral, meaning not affecting global output, it would require the US dollar to rise by as much as 25%, which is unlikely to happen, but it gives you a sense of where the risks lie to the US dollar and where the risks on the downside lie for the Canadian dollar.
Great conversation with Beata Caranci, Chief Economist at TD Bank, and again, just great insights in terms of what she's seeing right now.